Are you ready to join us on a travel down your path to prosperity? Tonight, we're going to be talking about a very controversial subject, whether 401k's have failed you. And if they have, how we can fix that problem. So join us for this edition of The Master of Money. This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. Tonight's special guest is Mr. Jeff Garbaz, Principal of Quantitative Partners. This Master of Money program was produced Tuesday, March 30th, 2015. Hello, everyone, and welcome to this edition of The Master of Money. I'm Steve Beeman, your host, and what a pleasure it is to join with you once a week to provide you the insights that we hope you enjoy to build a better path to wealth for you and your family. Now, tonight's program may run a little longer than usual. We had an extended interview with Jeff Garbaz, our friend from Quantitative Partners, and I want to show you the whole thing. I didn't want to edit it down. So we're going to show you a nice interview with Jeff that will give you some insights into how he built such wonderful returns in the markets. Now, there's a lot of publicity today about 401k's. In fact, there's a big push in Washington that says these things have failed as an experiment. In order to provide retirement for American citizens, the 401k plan was put in 30 years ago, and we're now looking at the results saying maybe they're not so good. So tonight, I'm going to look at the 401k plan, why it hasn't worked. And from that, we're going to see if we can establish some ways to make it work for you. And that's what's so very, very important. So stay with us for this entire show. If you're in that pre-retirement age of 55 to 65, or if you're starting to plan retirement, let's say at 40, you really want to watch this program because it relates directly to your family's financial future. Now, last week, we talked about the efficient market hypothesis and the corollary, the efficient frontier. And we talked about how those two very well-recognized academic theories have been used to build investment products that, well, they look like they make total sense. But in reality, they may be being used to build investment schemes for you under the umbrella, especially of a 401k, that might be setting up a trap for you based on current economic environments. We want to watch that and talk about it with you each and every time we can, because it's so important that you understand how sometimes these academic theories, well, when they play out in the real world, they blow up. Well, in addition to that, we had a chance to talk to Jeff once again about his March Madness schedule and about how he used some of that same idea from March Madness into his investment strategy. I don't always recommend people use sports analogies, but in that one, it worked pretty darn well. So we enjoyed our time with Jeff, and we got a lot of feedback on that one about the efficient frontier. So if you have any questions on those or any other programs, we urge you to write us at questions@safefinancial.org, and we'll make sure to get you an answer as fast as we can. In fact, looking at viewer questions this week, we had a gentleman write in, and he said, hey, I bought a whole life policy years ago. I'm wondering if I should continue it and pay it out or if it's a good investment. Well, I wanted to talk about this because there are different schools of thought. A lot of the most well-known financial advisors, Susie Orman, Dave Ramsey, they will tell you never to touch anything other than term life, that to use whole life or universal life is just wasting your money. And let me give you the numbers on this guy. He's had the program about 10 years, and his premium runs about $1,000 a year. So over the 10 years' time, he has accumulated a cash value of $9,000 and a death benefit, I think it's $50,000 now fully paid. Now, here's the thing investment people will look at. They'll say, what kind of an investment gives you $10,000 invested in a $9,000 return? That's not a very good return. And from that standpoint, I can understand why the Susie Ormans, again, or the Dave Ramseys would say, why don't you buy term insurance, which is very inexpensive, and invest the rest? Clearly, the returns from just investing the rest would be superior to your buying a whole life or universal life policy. But here's the rub, and this has to do with the psychology of people. Is that gentleman better off today having saved $9,000 Or would he be better off if he hadn't done it and perhaps hadn't saved anything? And that's a discussion I have with people when it comes to these life insurance policies. When I was 20, I started my first universal life policy. I put a small amount of money in each and every month, and it was about 10 years later, the money I had accumulated in the cash value is what I used to start my first company. Now, the reality is the investment return on that cash probably wasn't that great. But had I not had it in an insurance plan, I never would have saved the money. And there's the difference. Just because in theory you should say buy term and invest the rest, it doesn't mean always that people will do that. And it's trying to get people to save that's so important. So if you're a younger person especially, and you're looking at a forced savings account, well, these aren't always that bad. But clearly, if you're disciplined enough to put away money on your own, then the idea of buy term and invest the rest makes sense. So I had a chance to chat with this gentleman about it. We talked about some ideas he could do going forward. And I hope that insight helps you determine whether or not, especially if you're starting out, a whole or universal life policy is right for you. Now, moving into the geopolitical events of the week, what a week it was. The Middle East continues to be a tinderbox. We had Saudi Arabia invade virtually Yemen, which is a failed country, once hailed as an example of what the U.S. would like to see in these countries. It's now completely collapsed. As you have the Houthis, which are a Iran-based organization, coming in to take power, the Saudis wanted to fight back. So you've got the Saudis with U.S. support fighting the Houthis in Yemen. All the while, the U.S. is supporting Iran fighting the Islamic State. So we've got a real mess developing in the Middle East, and you saw a response in the markets to that, with the markets taking a big hit mid-last week. You also saw oil prices jump up because there was an immediate concern that the Straits of Hormuz could be closed. This is a real problem for not just the United States, but for the entire world right now, and the U.S. has to put a consistent policy in place. There is a power vacuum created in the Middle East, as we've tried in this country apparently to restructure our alliances in the Mideast, moving away from Israel, trying to build friendships with some of the more hardline Islamic states like Iran. Well, right now it doesn't seem to be working. We just have chaos in the Mideast, and it seems to be getting worse. Well, this is something that most definitely affects the world markets for oil and affects the world markets for stability. As that flight to safety comes up, the U.S. dollar is the place that's landing. So you have strength in the dollar, a somewhat declining market as a result, and little fear over oil prices. Now, on that, we've talked at length about the oil that's been created through fracking and these other things. I don't think you have to worry about oil prices running up a huge amount here, barring some really cataclysmic event, because the supplies are still very strong throughout the world. But nonetheless, it does show you how fragile the economy is based on some of these changes that could happen in the Mideast. So we're keeping an eye on Yemen, and we'll certainly keep you posted as things change. By the way, on that, the society established a new Skype account. That's that technology that allows you to do video conferencing. It's under Safe Financial on Skype, and I welcome you to join us on Skype. Every day we post a commentary that goes out to our membership, both on our Facebook page and our Skype page. And if you'd like to get daily updates on some of these things like in Yemen, feel free to subscribe either through Skype or through the Society's Facebook page or the Society's webpage. Keep in touch through that so you don't get caught behind. Now, as Saudi Arabia did that, on a second channel, the U.S. Congress authorized money to provide weaponry to the Ukraine in its fight against the Russian-backed insurgents. Now, again, this is an enormously complex mess that's been created in the Ukraine because Europe is starting to move away from the stated NATO position. Russia's Premier Vladimir Putin last week or 2 weeks ago went to Germany and France separately from NATO and worked with them to create a peace program for Ukraine. Well, both of them seem to be open-minded to doing it, again, ex-NATO, and that creates a real confusion in the region. Who's in charge? This regime in the Ukraine was installed by the U.S. and Western-backed forces. If they don't support them and the Russian forces take over Ukraine, what does it say about the strength of NATO? That's a scary thing. Again, we've talked about Greece and how that could have an impact on this. This real hotbed in NATO and the weakness that the U.S. has shown there is beginning to show effect. It's showing in the Ukraine. By the way, I'll mention a commentary that shows you just how sensitive this is. One of the congressional leaders in Chechnya, one of the Russian republics, actually came out and he said, if the U.S. arms the rebels in the Ukraine, well, then we are going to arm the rebels in Mexico who think the southwestern United States belongs to Mexico. I mean, that shows you how this can get out of hand really quick. The markets haven't really responded to it, but as we watch the European Union, the situation in Greece, and now this extending military behavior on the part of the Russians in the Ukraine, well, all that says risk factors, and that means you need to be listening carefully when we tell you to put risk controls on your portfolio. In the U.S. economy, we did get final fourth quarter numbers, and the U.S. came in with a relatively robust 2.2% growth rate. That was good news and welcomed by everyone, but the numbers haven't been consistently good. As I've discussed with you, we have this bipolar circumstance where some numbers are strong, these numbers aren't. Pardon me. And so this skittishness in the economy is being reflected in overall numbers. In fact, there was an article written by Business Insider, and if you want this article, by the way, feel free to write me at steve@safefinancial.org, and I'll get you this article. But it said in it, something weird is going on in the U.S. economy, and, quote, it's not good. We've talked about this. The economy seems to be wanting to move forward, but we can't seem to get a grip on it. Consumer confidence, which had come up so high in the fourth quarter, died off in the first quarter. Consumer spending, which boomed in the fourth quarter early because of gas prices, has now flattened out. Home sales seem to be picking up, but future home starts seem to be dropping off. Very confusing economic circumstance. Throw into that the concerns of the Fed raising interest rates, and lo and behold, you've got a mess in the markets. All it says is keep your risk controls in place. I had a discussion with one of our masters of money just last week, and he was saying how he was uncomfortable with how high the market was. He looked at all these risks, so he was getting out. What I shared with him is that's the wrong response. Just because it seems to you emotionally that things are unstable and getting bad, that doesn't mean you should be out of the market. Let the numbers speak for themselves. So what I suggested to him is that he go back into his position, but put a stop loss or a hedge against that position so that if it did come down, he was protected. Remember, and I'm going to talk about this a little later, but many of you at the bottom of the market in 2008 and 9 got out because you were afraid it would never come back. Well, if you did that at about 8,000, you missed a run to 18,000. We don't want to give up opportunity out of fear. We just want to have better risk controls. And this economy and the data coming out all say put in really strong risk controls. Now, last week I mentioned to you also about the new Chinese infrastructure bank. I talked about how China, together with Japan and even Australia, were looking to partner on a Chinese-led investment bank that may be comparable to the International Monetary Fund, but it nonetheless is directly head-to-head competitive with the U.S. being the reserve currency. Well, last week, Moscow joined in, so you now have Russia joining this new investment bank, all of which says the U.S. and its dollar is becoming a little more isolated. Again, think about your investments from a global perspective. This investment bank could be good for the Far East, could be bad for the U.S. So how do you do that? You make sure you have global exposure in your stocks, and you make sure you have risk controls. Remember, Wall Street doesn't like to lose money, and neither should you. So be aware that the world is coming together. There are opportunities to invest all over the place, but you want to do so with very tight risk controls. I urge you to write me, by the way, again, at questions@safefinancial.org, or write me personally at steve@safefinancial.org. The dialogue we're building with Master of Money members is really expanding and extending, and I'm very pleased with it. We're getting more and more people who join our meetup groups. We're getting more and more people who write in with questions and comments. We're getting more and more people on our Facebook page, on our Safe Financial Network to view the videos. So we want to thank everyone who's helped with that. And by the way, We urge you, and I'm going to mention this increasingly over time, I think, but I urge you to tell your friends about the Master of Money. The more people who watch, the more content we can provide. So, or tell your friends, your family, let's get as many people as we can to build this path to prosperity for all of us. And as I said, when we come back, we're going to be talking about what has become a very controversial topic, whether or not 401k's have failed. There's a lot of academic research that says, yes, they have failed as an experiment. The real world is a little bit different. But we want to talk together tonight about whether or not they have failed. And if they have, why they failed, and what could have been done or could be done now to fix them. We need retirement programs in this country. We want them. We want people to be able to retire wealthy, not poor. This issue right now is coming to light because every single day, 10,000 of the baby boomers retire. About 9,000 of them aren't ready for it. And there are two big effects on this. Well, not just two, but two big ones. Number one, these retirees are not retiring in the style they want, so they're all going to work at Walmart, right? There are only so many of those jobs. But there's a more insidious problem that's developing. Increasingly, workers beyond the age of 65 are not leaving their jobs. And while they may not be as productive as they were because they mentally should be in retirement, not working, they're staying with their employers who can't fire them because of the age discrimination rules. But they're draining productivity in some cases out of those employers. This is a real problem for a plan sponsor, that is the employer, and it's going to get worse over time. So when we come back, we're going to look into 401k's. We're going to talk about whether they failed, if they have, why, and what we can do about it. So stay tuned for this edition of The Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back, everyone, to the Master of Money program. I appreciate, as always, that you stay with us for this. It's important, especially when we have nights like tonight, we're talking about a very controversial topic, and it's important that you have your arms wrapped around it, especially, again, if you're in that pre-retirement stage of 55 to 65, this information tonight is absolutely critical to you. So we're glad that you've chosen to stay with us. We got a great segment with Jeff coming up, too, which I think you'll enjoy. But I mentioned earlier in the program, and I want to mention once again, by the way, that all of the archives of the Master of Money, as well as our Safe Insights, are up on safefinancial.org on the web. Go onto the site, just click on the Safe Financial Network, and you can get to all of our archives. You can get to all of the Safe Insights we've published, and I think you'll find many of the answers to your questions there. So feel free to take advantage of that as a resource. And I did mention, in addition to our YouTube channel under Safe Financial, our Facebook page under the Safe Society or the Society to Advance Financial Education, we created a Skype address as well under Safe Financial, so you're welcome to communicate with us through that if that's your preferred method of communication. We do whatever we can to make it easier for you, because this is a critical thing for all Americans to have the information, tools, and resources they need to build the wealth they require to retire. If we look at the United States today and we talk about its problems, you and I would clearly talk about our debts at 110% of GDP. We might talk about our unfunded liabilities at $100 trillion. We might talk about college loans now facing $1 trillion problem there. But I would make the argument that one of the most immediate problems we have is a retirement crisis of massive proportion. What's happened very simply is since the late 70s, we've migrated people from defined benefit plans into the defined contribution 401k plan. You all know this, you're aware of it, and most of you participate in them. These programs really came to light after the market debacle of the 70s, which caused all the defined benefit plans so much trouble. So we gave people the responsibility and portability of a 401k. Well, we did so in a vacuum. Might have been a great idea, but the reality is the people who were now responsible for their own retirement weren't educated in this stuff. And so now roll the clock forward 30 years, and there are some really frightening statistics. If you look out at the average 401k across all of them, so from startups to cash outs, the average amount in a 401k is $10,000. Now, if we look even a little worse at people pre-retirement, so we take out and look at people 55 to 65, their average in that basket is about $60,000. If you've ever thought about retirement, that's not a very fine retirement. The outcome of that and the result of that is significant. It means people are going to work longer, but they'll work longer in a less productive way because they think they should be in retirement. That's a drain on company efficiency. They'll be looking for secondary jobs after they retire. But as we've talked, there are only so many Walmart greeter jobs you can have. Third is they're going to look to the government to help. And that's where those deficits and debts and unfundeds just grow even more. So this is a problem we have to deal with. And the question is, has the 401k plan failed, or have we failed? And I want to take a look at that with you. I believe there are a couple of things, but let's take a look at the first most obvious one. And this gets to the heart of the existence of the society and what I talk about every week. The reality is people weren't given the financial education they needed to build thrifty 401k plans, period. There's really nowhere that you can go to get a one-stop shop to get a consolidated, concise education about money. If we go to high schools, I think the best example I can give is last week, I went to my son's variety show at our local high school, and in one of the skits, between the actual parts of the show, they had a little skit. And in one of the skits, a student looked at a professor and said, "Hey, I'm thinking about taking your econ math class next year. What kind of things will I learn?" And the teacher looks down and says, "Well, we're going to teach you standard deviation and stochastics, and we're going to teach you how to do regression analysis." And the student kind of pauses and looks up at him and says, "How about teaching me something like how to balance a checkbook or how to file a tax return?" Well, the teacher kind of pauses and looks back and says, "We don't do that here." Well, that's a fact. They don't. It's not their fault. They assume that it's taught by the family and by other things. But in high schools, colleges, and nowhere else today can people find a consolidated source for financial education. There are a lot of people who are trying this. Dave Ramsey, again, Susie Orman, who I mentioned earlier, the Financial Education Council. A lot of people are doing this, the Jumpstart Coalition. But it's hard to get the message out to enough people. So you have small segments of the society who are starting to get the word, but the bulk of America is not. So this financial education thing is huge. We've got to get out to the people in the middle and give them the knowledge they need to invest their money so they can succeed in a 401k, not blow up. And I'll give you a couple of good examples of the blow up thing. When we look at the financial education issues, go back to the year 2000 when we had that massive tech bubble. How many 401k investors got excited, what was the word, irrationally exuberant about the markets and got into these tech stocks right at the top? They blew up. Or how many people bought into the real estate thing in their retirement plans in 2006, 7, only to be slaughtered in 2009? And how many of us, and I would include some of you, at the bottom of the market in 2008 got out of your stock positions because you were scared? It starts to come down and you think, my Lord, it could go to zero. It's never happened, but it could. And the fear mongers were everywhere, whether it was Mark Faber or any of the others, telling you to get out of stocks, buy gold, run for the hills, the dollar's going to collapse, the world is at an end. Well, if you listen to them, you lost a lot of money, where if you let your mind run, not your heart, you would have been in the market at 8,000 and run it up to 18,000 and more than doubled your money. But this education that helps people remain calm, go back to It's a Wonderful Life, when everybody's panicking and selling, Mr. Potter's buying. We want to make the masters of money all Mr. Potter. We want you to be able to know that when the market comes down, there may be opportunities. Use the mind, not the heart, but that's all about education. So that clearly is the number one failure that's caused 401k's problems. Number two, I want to talk about, this goes back to education, but it's human nature as well. As you know, people are short-sighted. More often than not, a person would rather spend today than save for tomorrow. That creates a huge problem in a retirement world. If you start saving at 20, you get a certain result when you turn 70. If you start saving at 40, you get a much different result. In fact, let me give you the numbers. Let's take a best case scenario. Let's say that your 401k, you're going to fully fund it, your employer's going to fully match it, and you're going to get market returns. If you started in 1980, and I have the numbers here somewhere. If you started in 1980, here it is, and you did the maximum contributions going to the maximum match from your employer and the market returns and invested that until today, you would have $1,528,000. You've become a millionaire off of your savings. But if you waited 20 years and didn't start that until you were 40 or 50, you'd only have $850,000. And that's best case. So one of the big problems 401k's have failed is human nature, people wanting to delay pain until tomorrow and take pleasure today. Well, the third thing is that assumption I just gave you has two big components, that employers match your 401k contributions and you take it, and secondly, that you can actually achieve market returns. And let me touch on that. Number one, a lot of folks, believe it or not, don't take the matching funds that are available because they're not aware they're available. This is, again, investor education at the core. But the other thing we find in the matching funds is that exactly in the worst possible time when the markets have come down, that's when the employers don't have the money to fund the matching contributions. So you have a double-edged sword there of the employer's economics not supporting it, but the employees being scared, not understanding it, so they don't take it. So that best case scenario I gave you comes down significantly. And the second one is something that I'm almost reticent to talk about because it's my industry that's been indicted for this. There have been examples of egregious fees charged to these 401k plans. Again, this is something that I don't even like to bring up, but it truly is an indictment of Wall Street. There was, for example, what's called a 403B, which is the sister plan for public employees out in Seattle. And when the research was done on it, they found that the plan provider was charging 12% a year as a fee. Well, let me put that in perspective. The average return over the stock market since 1980 has been 10.1%, give or take. If you're being charged a 12% fee every year, that means you're losing 2% a year. Now, you and I both can look at that and say, that's almost fraud. How could they possibly do this? Well, that sadly is going on in more places than we want to admit. So one of the things that's happening recently in a dynamic is lawsuits are being filed against the companies and these providers for charging these huge fees because it makes achieving the market return almost impossible. So clearly, an easy solution is that Wall Street gets its head together and starts charging reasonable fees for managing these assets. I'm not going to say, 1% may be too low, but I guarantee you 12% is too high. So we need to have some reasonable expectation from Wall Street on what they can make on these 401k's. And there's something called revenue sharing. If you got a 401k plan and you look into the details and find revenue sharing, that's a red flag. What that means is the plan provider, in other words, the investment company, is paying money to the plan sponsor in order to be put into the plan for you to invest in. It's a pay-for-play scheme. If you've got one of those, you want to almost seek legal help. I'm not an attorney, but I can tell you that's been the genesis of a lot of the legal fees. So the question comes down whether or not 401ks have failed, and they've failed because of education or lack thereof for the participants. They've failed because the emotions of people prevent them from putting money in when they should, and they failed because, frankly, Wall Street's taken advantage of them in some cases. Well, those three things are easily fixed if we can take something like the Master of Money to enough people. So I welcome you, tell your friends and family about this program, but if we can take this out to enough people, we can solve the education component. By doing that, we can also solve the emotional component, because if we can show people the power of compounding, I think we can persuade people to put money away today in savings for tomorrow. And finally, we have put in new regulations as fiduciary positions for both the plan sponsors and the plan providers. So now employees have a fiduciary sitting at the company level. And if you run a company and you've got a 401k, you better be aware that you are a fiduciary over those employees, and therefore you are responsible for them if the plan is charging egregious fees, or if this pay-for-play concept is giving them investment funds that aren't appropriate for them. Be well aware of that. We're working now aggressively with the Chamber of Commerce and with other organizations to get this message out to the plan sponsors so that employers don't get caught in a trap. A lot of them don't know they're responsible for these employees' plans, but they are. So we think there are solutions to fix the 401k. We do think it's probably the best way to go because it gives portability in a world now where people don't stay at one job. Because it gives matching, it's a nice tax preferred benefit for employees, but people have to be educated, they have to be disciplined, and they have to be treated fairly. We think those things are doable in the 401k space. Now, I'd like to move on to our interview with Jeff Garbaz. I had a chance to record this interview with Jeff the other day, and I'm very pleased that he was able to join us once again. And we're going to talk today about the idea of trading in and out of the markets. Some call it market timing, some call it tactical management. But this is something that 20 years ago you couldn't do. Today you can. And Jeff has some insight for you right now. Jeff, welcome once again to the Master of Money program. I'm so pleased that you've chosen to spend some time with our Masters of Money. They benefit greatly from your expertise. But let's start off with the most interesting stuff. How was that squash game on Saturday morning?
It was a pretty good one. I played a guy who's 24, and I got him 11-7, 11-9, and 11-9. So nothing like beating a guy who's half your age.
Yeah. Well, all we can say is we hope your average in squash beats your averages in stock picking.
Unfortunately, I don't think my my average in squash can beat my stock picking. So
no, not when you're hitting 70 and 80%, that's for sure. Well, again, thanks for being here. You had some ideas you wanted to share with our masters today, and I want to give you the floor to do that.
Okay, great. So what I'd like to talk about is the concept of basically mixing market timing with your stock picking abilities. Pretty much every newsletter that's out there, they try and recommend stocks, and that's all that they do. And I really feel to get the best benefit from this, you need to mix market timing with stock picking. Many try and talk down market timing, saying that it doesn't work, it's a bad thing. I have found nothing to believe that at all. And in fact, I think the financial industry likes to get people away from market timing so that their job is made easier because they don't have to deal with the constant turnover of stocks.
Well, and let's also talk, we've talked before about how transaction costs have come down so much with this kind of thing, with the invention of ETFs and other things, where 20 years ago, 30 years ago, you couldn't do this possibly and make money. But today, with ETFs and transaction costs, it's a doable thing.
Oh, yeah, absolutely. I mean, your costs are less than 1% to do a trade. So if you're in and out and you made 15%, you made 14%, no loss. Several years ago, it would have cost you 3 to 4%. So you would have been down to 11 or 12% type return.
Exactly.
So what's interesting is I went through and found a couple studies that kind of validate market timing from some pretty exceptional sources. First, the Kansas City Federal Reserve did a piece called Market Timing Strategies That Worked. So that was an interesting one to read. And then William Sharp, who's a Nobel Prize winner, had an article titled Likely Gains from Market Timing. So I think there's a lot out there that validates it. And you know, I mean, you look at people that are stock pickers, not to pick on anyone, but to actually pick on someone. Louis Navellier is known as being a great stock picker,
Yep.
but that guy constantly, you know, you get into a pull down, he's going to give up 20, 30% very quickly. And even the Investors Business Daily people that follow the CAN SLIM methodology, which is an acronym on how to invest, they see big drawdowns as well. So I think a key thing is how do we take down those drawdowns over time? And to me, it comes down to this: the ability to buy low and sell high constantly is what's going to separate results for a market timer. So how does one really go about timing the market? The first thing is that you need to have a really defined process, and then you need to validate the results. Recently, I saw someone who claimed to be a good market timer, and they did a study from 1993 forward. Why did they pick 93? Because they were doing some back testing and they're trying to do some curve fitting and come up with results. I would have been much more willing to accept the results if it had been to 1970 or 1950, but to take the year 1993 and to say that's how great this did, it really brings me to question whether that.
Well, Jeff, you know, I spent my early years doing all that back testing wonderful stuff on stock-specific research, and it's remarkable how you can make the data fit your desired outcome.
Exactly. So I think once you've got a process and a model, then you want to constantly tweak to improve the process. When something doesn't work, let's say you missed a signal, go back and figure out like, okay, what didn't I get there? What else could I look at? And then the key is to integrate it with portfolio construction. Now, we've talked a little bit in my discussions with you about how I do that. I have a technique I use called the market crash indicators, which resides in Superstock, and we update it every Friday morning. And it basically ranges between being fully invested, 75%, 50 cash, or 100% short. It's been a long time since we've been 100% short, and we're pretty much this year sticking between 50% and 75%. But what I do is I have a couple models I built myself. One is called the Madison Letter, which basically is a standard deviation process where I'm looking for extremes and trying to capture when we've had too much upside or when we've had too much downside. Then I use another model which I developed which is an advanced decline line model. I call it the QPI 80 line model. And then I have a moving average slope indicator as well. And then I also use high beta versus low beta stocks. And then I bring in two outside guys that I work with, Phil Erlanger. He's got a great indicator, the Erlanger Big Barf. And then Steve Simon, who I work with, he's got an indicator called the greed and fear indicator. So those six are what make up my process to determine how much I'm investing. And it's a good process, and it's worked. I mean, in the time that we've employed it, which is now going on 5 years, we're up 50-something, and the market's up 30-something. So those results validate.
Well, I'm a big believer in it. In fact, the Harvest folks who sponsor us use a tactical asset approach like that to serve their clients. And so more and more, I think we're seeing these abilities to trade in and out of the market rather than just a buy and hold mentality, which may have worked in a period from 1980 to now because you had declining rates and rising markets. But in a trader's market, I think I'd want to get in and out when I can.
Yeah, exactly. So then I take that market crash concept back to the Superstock Morning Matters portfolio, which is a 12-stock portfolio. And at the end of this year, we had 10 of 12 names invested. I always like to leave one slot open in case I come across a great idea. So I always like to have like at least 8% cash, which then means I'm 92% invested. And so we finished the year 10 out of 12 stocks, so 84% invested. And where we are now is we're down to 50% invested. So we have taken some names off. A couple of the names I feel really good about because we got the gains to be over a year, which is something we had talked about in past episodes. And I've done this by keeping the portfolio less than to 150% a year, so effectively 18 new names a year. And now I've got 6 names that I can go and add as the market is correcting here and having some trouble. Within that portfolio, just a couple quick thoughts. When you do a 12-stock portfolio, you want to be diversified, but you don't want to be diversified. Diversified is when you're going into a sector just to be in a sector.
Yeah.
So as an example, energy has just been horrific right now, and there's no reason to own any energy stocks right now. So I can be a little concentrated, but I try not to be overly concentrated. And still within that process, I'm trying to buy low and sell high. And then a key to that is constantly monitoring. And in like what we were talking about the other week, franchise stocks, I want to own some franchise stocks that I can own for a long period of time. And so since we started this process in 2008 and 2009, we did not use the market timing within it. And we had really good results in those 2 years. We did 90% and then 258%, which is, kind of hard to beat, right?
Yeah, that's a nice number.
And then 2010, we did 58. And 2011 was a bit of a tricky year. We actually lost. It's the only year we've lost a little bit of money. We lost 13%. And then 12, we made roughly 8. And then 2013, 42. And this past year, 40%. I'm really happy about this last year because the market really struggled. And to put up those type of numbers was really a great thing to do. And
well,
so
it speaks volumes, Jeff, to 2 things in my mind: the process that you employ and the wisdom and experience you bring to building the process.
Yeah, you're right. It's all about process. It's funny. I was visiting my parents a couple weeks ago, and we were talking about process, and my mom jumped up and she said, "I agree completely. You need process in things, and you need process in kind of everything. How you run a business, how you run a portfolio. If you're Bo Ryan and you're going for the Final Four this weekend, you need process as well there. So you got to have process."
Well, Jeff, that's excellent stuff, and I appreciate your joining us once again. Now, the masters of money that are watching us can get that research from Jeff. Just write me at steve@safefinancial.org, and I'll put you in touch with Jeff and his counterparts at Quantitative Partners and Superstock. It's great stuff. So, Jeff, thank you once again.
Thanks for having me, Steve.
Have a great week.
You too. Bye.
Well, folks, I hope you enjoyed that interview with Jeff. We're going to be incorporating more technology like that so we can bring you more and more guests and more information. Again, if you have questions about that, or if you have ideas for us on how we can make that a better segment or a better program, write us, please, at questions@safefinancial.org. Well, if anything tonight, we've talked about the fact that your destiny is in your hands. If you have a defined contribution retirement plan, the burden is on you to educate yourself, to know what you need to know, and to execute in a way that provides wealth for you and your family. It's time that we all dedicate a little bit of energy and time to educate ourselves. I think we could all agree on that. You don't want, above all, you don't want people in this country en masse retiring without the money to do so. The downside consequence to that is huge. So we have a responsibility to educate ourselves, educate our grandchildren, our children, and make sure they don't become wards of the state, which in the long run hurts every one of us. The idea of financial education has to become cool in our country. So hopefully the Master of Money program kind of does that. Well, anyway, we hope that you have a happy and prosperous week ahead, and I look forward to seeing you next week for a new edition of the Master of Money.